Hey folks, markets started the session slipping into the red as traders digested the latest jobs data and braced for next week's Fed decision. Then flipped green mid-morning and closed with modest gains across the board. Typical chop. We've seen this script play out enough to know it by heart. The 10-year yield ticked up to about 4.14%, prompting the usual position squaring, a bit of profit-taking, and that classic head fake to separate the timid from their shares. They'll be buying again soon enough. That's simply how the game works right now. Repeat after me. All this daily zigzag has absolutely nothing to do with the strengthening case for owning the very best businesses. Rates move traders, but growing profits reward investors. History is crystal clear. Staying aggressive, even while thinking defensively, is the path that wins. And always stick with the leaders, ignore the rest. Here's the rundown. 1. Netflix just rewrote the entertainment playbook. In a blockbuster move, Netflix is acquiring Warner Brothers film and TV studios along with HBO Max and all those legendary franchises DC, Harry Potter, Game of Thrones for $72 billion in equity, $82.7 billion enterprise value. This hands Netflix an unmatched library, massive production firepower, and instant scale against every rival. The stock dipped a couple % on the announcement, normal reaction to the big price tag and added debt, but step back and look bigger. They're targeting $2 to $3 billion in annual synergies, vowing to keep theatrical releases, and if regulators sign off, Netflix emerges as the clear entertainment superpower for decades. Short-term noise, long-term dominance. Huge potential for patient investors. Investing take. Transformative deals like this are how empires get built. Focus on who owns the content kingdom tomorrow. 2. SoFi tops the markets for fresh fuel. SoFi Technologies priced a $1.5 billion share offering 54.5 million shares at $27.50 to bolster the balance sheet and keep the growth engine roaring. The stock gave back some ground on the dilution, which is par for the course after this year's massive run. But zoom out. This is a fintech leader posting 38% revenue growth, profits more than doubling, and expanding fast across lending, banking, and payments. Raising capital now, while the window is wide open, is smart offense. Temporary dip, permanent strength. The core story is still very much intact. Investing take. Strong companies raise when they can, not when they must. Watch what they do with the cash. 3. Quick look at the broader market. The major indexes finished slightly higher, S&P adding about 0.3% near 6870, Nasdaq up a similar amount, Dow gaining a couple hundred points. We're hugging all-time highs, volatility remains low, and the December rate cut looks basically priced in. Steady, grind higher action driven by solid fundamentals, no fireworks, just progress. Your job isn't guessing the next squiggle on the chart. It's recognizing the major shifts underway, like entertainment consolidation or digital finance disruption, and positioning yourself to benefit. Stay locked on the winners, tune out the short-term drama, and keep compounding. That's the formula that works.